Well, hi folks, and welcome to another episode of Trader Cafe. Well, today we're on our favourite topic, or one of my favourite topics, which is the macro overview. So what the plan here is, we're going to have a scoot around the world just to really catch up with the three key themes that I have in terms of the way I look at the world. And as we do that, hopefully you'll learn a few things. And each time I try and bring a slightly different flavour to the conversation. So we're just trying to, if you like, get a feel for some of the tensions that are out there in the world and the way that people are trying to react to them. So over the course of the last month, there's been some really interesting developments. And of course, for those of you that are following the equity markets, it's been certainly been a slightly more interesting time than it has been for some time, right? So the market has been a bit crazy, and as a result of that, we have lots of I think probably lots of things that we could talk about, but this time around, as always, what I'm going to really talk about, just two or three things that I think are really pretty super important right now. So, guys, bear with me just while I get the slideshow set up, and hopefully you can see this. Just hold on 2 seconds. Okay, cool. Okay, so hopefully everybody can see the slideshow now, and what we have going on. Awesome, that's brilliant. Thank you very much for helping me out here, Mai. So, as always, we start with a disclaimer, because obviously, as you guys know, this is really about education. It's not really about me giving you trading advice during these talks. What we're really trying to do here is to give you some additional background. What we think about as a trader is to develop our edge, and when we're thinking about developing our edge, that comes in a number of different ways, right? Doesn't it, guys? So when we've talked about this a few times, but for those of you who are new to the show, the way I like to think about things is in three different ways. First off is to try and get a handle on those overall, the best markets to trade for the way which we trade. So, on the assumption that you're either going to be trading trends or you're going to be trading ranges, then what you really need to do is to have a scoot around the world and try and find the markets which are best fitting those categories, right? So a lot of us tend to be trend traders, and that really sort of determines some of our approaches to the way the world works. And depending on how sophisticated we are, how new we are in the markets, and also our personality, that means that sometimes we trade them in a very short term, looking for trends, and sometimes we do it in a more longer term. I'm a little bit of an older trader. I've been around the blocks a little bit, and I tend to be a little bit laid back. So as a result of that, I tend to look at daily charts as my key time frame, and that's something I can manage while I have other responsibilities during the day, so I only have to look at markets about an hour and a half a day. And so really I encourage everybody to take some time and always try and figure out what your skill set is, right? And where you can add, if you like, add some value to the trading conversation. So what we're trying to do here is we're going to go through some of those fundamentals around some of those markets. Now, the other bits of of my way in which I think about trading, such as the actual trading timing itself and risk management. So we don't cover that in the Trader Cafe. This is really to focus in on that fundamental information. So hopefully, guys, you'll see the journey as it unfolds. And as I always say with this thing, it's about developing your edge, right? So how I view the macro overview is it just adds a little bit of clarity to me. So now, why does that matter? Well, that matters because as traders, what are we always trying to do, right? So we're trying to take a position, unless you're incredibly systematic and you say, right, I trade when I trade without any sense of what the market conditions are. I just get a signal and I take it. If you're a technical trader that way, then maybe some of this isn't that relevant for you. But most of us are some kind of hybrid, right? We either trade those long-term fundamentals or else we trade some kind of hybrid. We're conscious of those of those market conditions before we take a trade. And then that also helps us act as part of a filter. So again, why is that important? Well, okay, it's important because this enables us to have confidence. Now, what does confidence mean? Okay, confidence drives your ability to be able to take aggressive positions when you need to. Now, what I mean by aggressive, well, maybe if you're trading 1% on an account, you might say this time I'll take 1.5, I may even take 2. As an example, you don't do it very often. It happens very rarely, but once a month, depending on how many trades you do, say 1 out of every 20 trades, you're going to put something like that on, right? You go, I've got full conviction in this trade, and I'm going to take that. Now, as your confidence grows, then you'll be more aggressive. You'll get into the swing of being more aggressive, being less aggressive as time allows, right? And that's the key thing to developing your edge as a trader. Okay, so what we're trying to do here, like I said in these sessions, is not to talk about the risk management side of that or the timing side of it. What we're really talking about is why do we do this, right? So what's going on in the world? Now, look, I have 3 key themes, and we'll come back to those in a minute. But in my mind at the moment, this is really what I'm seeing as things happen at the moment. So we've been talking about a correction in the equity markets coming up in maybe September and October for quite some time now. Folks who have listened to this show now for 3 or 4 months would recognize me saying there's been some real dangers. Have we had the last piece of sand on the sand pile that creates the avalanche, right? So, or the Minsky moment, are we at that point in the stock market? Well, we've seen a correction. Now, is it a big correction? No, we haven't even got down to the 200-day moving average yet, if you define that as being a reasonable correction for the S&P 500. So we are correcting more than we have done in the past. It went down for more than 2 days before it then bounced back to a brand new high. But as we saw on Friday, the stock market still trades fairly well and has had a couple of really good days and has come back quite considerably. And maybe if we have a little bit of time, we'll have a look at that at the end. I'm not sure. But let's suffice to say that I feel the equity markets are in a corrective mode until probably the end of this month, maybe the beginning of next month. China is a situation we're all watching much more closely these days, and there's a really good reason. I saw a chart, I think this morning, which said that the Chinese real estate market is the biggest market in the world. I think it's $65 trillion, something like that, which is an enormous amount of money. And so in China, the real estate market matters. Outside China, the real estate market matters for Chinese investors. And also within China at the moment, we have some problems. Now, everybody's aware of Evergrande as that crisis unfolds. Yeah, they've got a lot of debt. I think $300 billion equivalent, something like that. It's an enormous company with enormous debts. I'm sure they have a lot of assets as well too, but they're clearly struggling right now. And as they struggle, right, that creates a lack of confidence in that market, and I think has been one of the reasons why the Chinese stock market has been so quiet this year overall. And maybe we'll have a quick chance to have a look through that. I still continue to see the growth in inflation continuing to fall. So that doesn't mean to say that inflation itself is continuing to fall, but the growth in inflation is continuing to fall. So after the big bounce back we had in the first half of this year in inflation, we've seen the growth of that. So in other words, each subsequent month, we've seen that growth, especially in the US, start to slow down, right? Which suggests that there's a moderation. Okay, so, and one of my favorite reasons, and we'll come back to this hopefully this time, if not, because we're looking at a couple of things around bank debt, but there's one of my favorite sort of realizations around the inflationary environment at the moment is I don't quite know how it can take off, because if inflation is 6% or 5% in the US, whatever it is, you need wages to keep up, right? So wages have to be running at 4 or 5%. And when you think about it that way, do you have inflation or not? Well, no, you're actually no better off than where you were before, because essentially both prices have risen, but wages have risen at the same time as well too. The death cross in inflation is when inflation is rising faster than wages. And we've seen that in some sectors and some markets. You know, if you're trying to build a house at the moment, I'm sure you guys are seeing that in some sectors and some markets. In America, there seems to be a bounce back in wages and salaries, but I'm not seeing that necessarily happening here as much. So Hopefully, guys, you can hear me okay. I can see that the internet may be coming in and out a little bit, but we'll move on to the last thing as well too. The last point I want to talk about is the gold and silver market. Are we going to trade higher soon, or is it still a function of the market waiting for something to happen? We'll have a quick look at the charts if we get the time. I'll pull them up and we'll have a quick look and see where we're at with those. So, okay. If we just move on to the three key themes. So as always with this, what I like to try and do is to identify the three key themes that I'm looking at any one point in time, right? And from time to time, these might change, but for the time being, I don't see any reason to change them. And the reason why I'm not going to change them is because I think this is all people are talking about, right? Okay, so fiscal deficits, as we know, are rising. Inflation, as we know, is rising, but not as much. Thankfully, in some countries, the pandemic is more under control. Sadly, in New Zealand, we're struggling with that at the moment. It seems to be going in the opposite direction, which is the same in other countries around the world. But equally, there's many countries who are doing a little bit better or who have vaccinated the population, therefore trying to get back to normal, right? Whatever that means. And I think this disjointed approach whereby around the world there are different outcomes from the pandemic. I think that's something we always have to bear in mind, because often we tend to focus on what's going on locally to us. And as a result of that, that can lead to a little bit of confusion about what the world is seeing, right? And sometimes when you look at this, you go, well, I don't really understand what's going on out there, because where I'm from, the point at where I'm looking, then there isn't a problem, or there's a really big problem, right? But what you're forgetting is that different places, different countries have different outlooks. The United States, I think, is really struggling with some aspects of the pandemic. And whereas in Britain, they still have a reasonably high case count going through at the moment, and there's still sadly many people who are losing their lives every day. But the flip side is the country has decided that it's going to manage, and it's just going to get through this and as best they can. And so maybe lots of cases, but the severity of cases is extremely low. And that's the result of the vaccination program. So when you see these things, you're going, okay, that's interesting. You tend to have the people who are in hospital as being the ones that aren't vaccinated. And as a result of that, I think that causes a lot of social dislocation. So we're not going to spend much time on the pandemic this time around, but I just want people to bear in mind that that disjointed approach means that you can sometimes miss the investment opportunities or the opportunities that are going through. So, okay, let's crack on. Today, we've looked in the past at different aspects to inflation, and we will look at a couple of commodities later on, but that's for a slightly different reason. Today, what we're going to do is we're going to, as always, we start with the economic surprise index. We just take a quick update of where it was. When we had this session last time in September, the economic surprise index was not doing very well, right? It hadn't bottomed out. Now, as you can see, here we're sitting, and apologize, this is American date format, but you can see that this is October 8th. The economic surprise index has bottomed out a little bit. So what does this chart mean? It means that when it is at zero, then the economists' forecast match what actually comes out when economic data is reported. When it's below zero, that means that the economic data is underperforming against those forecasts. And when it is above zero, then the economy is doing better than the economists' forecasts for what it should be doing. So for those of you who follow the non-farm payrolls, you will see yet again it was another crappy number. It wasn't very good. Yes, 200,000 people found work, but there was a really weird thing in there about government that I don't think anybody understood as to why so many people in the government lost their jobs last month. Maybe it's something to do with the debt ceiling, who knows. Some days there are just aberrations, and it may be that that's just an aberration which will be revised up. But the overall theme was we're adding jobs, but not at the rate that everybody would like to see those jobs being added in order to be self-sustaining within the economy and showing the type of strength that you need from an economic standpoint for the Fed to start seriously thinking about taking some action. Okay, so around the world, we're seeing the same thing as well too. There's that general underperformance of the economies compared to where it is. So whilst the economies are underperforming, obviously, we've had a little bit of a hiccup in the S&P since we last showed this chart. But quite frankly, compared to other markets in the world, i.e., in this case, I'm looking at the Chinese market, the S&P hasn't exactly had a bad year, right? This is showing it from May 2020. So I guess you could argue just after the pandemic low. On the market, the S&P is up 40%. I know that the Chinese market in that time is still up 25 to 26%. But what's interesting is what's happened since the beginning of 2021. The S&P is still forging ahead 10, 15% higher, but the Chinese market is flat. Right, and that may be to do with the property. It may also be to do with the tech companies. It may also do with online education. There's a number of headwinds that the Chinese economy has at the moment. It doesn't mean to say that that's a bad thing. In fact, if anything, you could argue that the Chinese market is undervalued against some of those other Western countries in terms of how their markets have been performing. So there may be an opportunity there for an investment trade to sell America, buy China, for instance, and to see how that unfolds. So again, when you look at China over the course, this is just a China on its own over the course of the last 5 or 6 years, you can see really that market has done nothing. You go look at the S&P since 2015, it's been, apart from 2020, pretty much a straight line up and has done incredibly well and is way better off than where the market would be. If this was the S&P, you'd expect the S&P to be trading around the 10,000 mark, something like that, I think. So there's a real sense of the Chinese market offering, I think, some value here, but that's my opinion. We have to wait and see what unfolds. But as you can see, for the last 18 months, it's sort of kept its bullish momentum vaguely, but again, this year it hasn't done an awful lot. Last year was a great year. The year before was a reasonably good year, but obviously a crappy year in 18. But since, apart from those, it's been reasonably consistent. And so when you see 2021 and you're seeing underperformance here, then maybe there's an opportunity for something to happen towards the end of the year. So just bear that in mind, guys. Right. Okay. So this section is supposed to be about inflation. And one of the things I wanted to talk to you today is about one of the reasons why inflation sort of happens, right? So when you think about QE, and there's a bit of a debate going around at the moment about whether QE is effective or not, right? Of course, what QE does is the government sells some bonds, and the Fed, well, actually, the government doesn't necessarily sell some bonds, but the Fed goes into the market and purchases a whole bunch of bonds and gives everybody a lot of cash, right? So anybody who's got a treasury bond out there, the Fed buys it off them and gives them heaps of cash as a result. Okay, so that normally, what would happen to that cash? Normally it would go into the banks, and the banks would then say, okay, great, we can on-lend that to customers because customers are desperate for loans. Well, what has been happening over the course of the last few years is there's been something odd taking place, right? Yes, you could argue that the velocity of money is falling for those of you who are monetary economic aficionados, and that's certainly been a consequence of what has been taking place. But the reality is, in order to generate inflation, you need banks to lend money and people to borrow money, invest in things, and drive prices up. Okay, so what we're seeing at the moment, though, is the exact opposite. What we're seeing at the moment is actually a lack of loans and a lack of loan growth. And in fact, since you can see this year-on-year change down here, since around about this time last year, the rate of growth of loans has really started to tail off. This particular instance, it's Europe. But look at the previous few years, from 1999 through to 08. You can see that that lending, in fact, was going great guns, and then it's just sort of stalled in the last few years, right? So, okay, is that Europe's problem? Well, when you look at the US, what's been going on in the US? Well, what's been happening is that the US has been replacing loans, so loan growth, right? You look at this here where you have treasuries and agency papers, so in other words, not lending to real customers, but just buying government debt, has been increasing and increasing and increasing. In fact, since 2008, it has gone from over 9% to 21%. So a lot of the American banks have grown their balance sheet by buying government debt and not by lending to real people out there in the street. So there doesn't appear to have been a lot of lending taking place. So if there's not a lot of lending taking place, then what's going on? Well, that's the reason why, in my humble opinion, we're struggling to get much past the transitory nature of inflation. In fact, I become increasingly concerned that the lending not only isn't picking up, but in fact the lending is reducing even more. And if you begin to see, excuse me, and if you begin to see what's going on in terms of some of the car sales in the States and also other durable goods as well too, those durable goods sales are beginning to fall. And that's actually quite interesting. Not the rate of growth, but the actual durable goods sales in the economy are beginning to fall. So there's a lot of factors coming into play here where I see the economy as starting to not stagnate, but starting to slow down and not go the way that everybody thought it was going to go this time of year. Do you remember that surprise index, right? So the economists all had this beautiful upward sloping re-energization since the COVID was over and everybody had their vaccines and they opened up again. Well, that isn't happening. And again, if we're seeing this through loan growth, there is no loan growth. And as a result of that, what's happening is that if there's no loan growth in the long run, there will not be any inflation. And that, I think, is one of the key drivers for this market. So as I said, a consequence of this would be the money supply in the economy and the velocity of that money as it spins around the economy continues to fall, even as the Fed's balance sheet gets bigger and bigger and bigger. In other words, QE isn't working. That's the strap line for all of this. So now, worrywart, we say, okay, well, if, and again, I keep coming back to this over and over again, every single presentation, I keep coming back to this. What is going on in 10-year yields? Yeah, 10-year yields have been rising slightly. Oh my God, right now we're sitting at about 153 for 10-year yields. Well, last time I looked, inflation was running at over 5%. So who knows the best? Or does the bond market know best? Or does the inflation that we see out there think that it's going to be secular and continue to grow even next year? I've had people turn around to me and say they reckon inflation is going to get into double digits in the next 6 months. You know, I can't imagine why that would be the case. That sounds completely mad to me. So it's just odd. It wouldn't be the case if bonds were sitting at 1.5%, right? Because that would be a negative yield of about 8.5%. That's completely insane. So it won't happen, right? The bond market is normally way cleverer than the underlying economics, or certainly than the stock market. That's for sure. So when I see yields of 1.5% and they're not really budging off that 1.5%, sure, 15 basis points either way, but who cares? And you've got inflation at 5%. It suggests to me that inflation is going to come straight back down again. I don't know when, I don't know how, but that I think is going to be certainly the way that the world is going to be looking at inflation going forward, for me anyway. So when I look at our key themes, right, brief scoot around, we've just had a quick chat around the inflation world. Fiscal deficits, again, this time of year, there's not really a lot going on with fiscal deficits. Gira, I'll come to your question in a second. And then finally, the pandemic area. We've had a brief talk about the pandemic and what we're seeing with that. I think one of my key takeaways at the moment is that there seems to be a lot of confusion and volatility is starting to pick up. We've talked about this from time to time, and traditionally volatility is really good for the traders, right? Traders like volatility. You certainly prefer it to no volatility. However, the wrong type of volatility would be very interesting. And I wonder, what we're seeing is lots of noise and lots of shuffling around going on at the moment as people rebalance their portfolios in different ways. But we're not actually seeing any real substantial trends start to come forward. There may be a couple starting at the moment, and we'll look at those in just a minute. But what we are seeing is the end of a lot of trends. And I think that's the key difference to what the environment we're going into now. And that probably is the reason why we're going to see more volatility going forward. Right, hang on a second. So Jira's asked, is the relationship between bond yields and inflation direct or inverse? So as inflation goes up, Jira, you would normally expect bond yields to follow, reluctantly, but they will follow. And it depends, right? As always with these answers, it depends. It depends on the extent of the inflationary boost. And it depends on the extent at which that transmission mechanism of interest rates is working through the economy. So you and I both know, Jira, that if you look at this now and you look and say, who can support the interest payments if interest rates double? right? It's not necessarily the households. Yeah, they're going to have a rough time because their mortgage payments are going to be quite a lot more expensive. But the reality is the people who can't afford things at the moment are mostly governments. Ironically, the US is in one of the better positions in terms of interest rate affordability around the world. Not their debt to GDP, but their interest rate affordability. The US is poor, but it's nowhere near as poor as places like France and, in fact, China as well too, in some respects. So there's a few countries out there where the interest rate, the payments that they have to put up every year are reaching, has the potential to reach quite extensive levels, over 20% of government costs if interest rates rise to any great extent. And so therefore the logical conclusion to this is interest rates aren't going up. But then you've got to then look at it and go, well, so what's really going on then? Well, interest rates aren't going up because there's actually no inflation, right? And so you start to look at this, the relationship between yields and inflation in a really interesting way. So traditionally, over time, you would expect if inflation was secular that yields would follow. If inflation is transitory, then yields might not necessarily follow. There we go. That's the right answer to your question, I think. We got there in the end. So, Crystal, so will US stocks go up Thanksgiving, Christmas this year? So I think you're referring to the every year this happens, the Christmas rally, apart from the years when it doesn't. And there's one or two very famous years. I think, was it 2018? I get my years out of kilter. Go and have a look, guys. I think it was 2018 Christmas was a bit of a hiccup. And so it doesn't happen every single year, but traditionally there is a Thanksgiving rally. And so one of the questions you've got to ask yourself is the market setting itself up for that Thanksgiving rally? And the answer to that is probably it's beginning to now. So we're seeing a sell-off. We're getting to the point where people who have owned stocks are maybe having some second thoughts. The difficulty that I have is that I'm not seeing any sellers because the market still goes down and then bounces back. We need to see a little bit more work done on the downside, I think, to get this market oversold before I'll feel very confident in the Christmas rally again this year. Until then, I'm not sure. And as always, it's really difficult to predict, Crystal. So what you want to do is to set yourself up to be able to take advantage of that when it comes. Okay, because we don't know. There may not be a rally. And if there isn't a rally, then things are going to be quite tricky for you if you set yourself up the wrong way and just decided to buy anyway without looking at the technical signals. So, as always with these things, if you're taking positions, put a stop loss in place and make sure that you're giving the trade room to breathe. And if you're looking to a Thanksgiving to Christmas rally, that's a 1 month trade. So you'd expect to have a 5 or even 10% stop loss on your position, probably 5%. So if you're thinking about that, just bear that in mind. You can't do that sort of rally and only have a 0.5% stop loss. It doesn't make any sense. But make sure that the price action is supporting the trade. Otherwise, don't take it. Okay. So as always, I'd just like to highlight, because we're not going to go through every single one today, I would like to highlight some elements of the Super 6. So as you recall last time, we had the euro was consolidating near the bottom of its trading range. Well, the short answer to all of this is it really hasn't changed that much, even in the last month or so. Yes, it's gone a bit lower, but it's still really at the bottom of a trading range in there. Dollar yen, much more interesting. We've seen a big move. Oil, again, much more interesting. We've seen a big move. Gold, I'm trying not to yawn whenever I look at a gold chart. It's sort of really stuck between 1680 and 1800, and it breaks either. It's interesting. It doesn't break them. It's still just as boring as it has been for the last few weeks. There is a seasonal trade, for those of you in the broadcast group, there was a seasonal trade on gold, which I have very little patience for, and it had better appear on Monday and start making some moves soon. Otherwise, that trade will be gone, pretty much at break even. The S&P 500, you guys, if you're following financial markets, will know what's happening there. We've had a bounce the last couple of days, really off quite a substantial fall in recent times, but not historically. It's been a very small move. And there's probably potential for more downside there. And then finally, the 30-year US Treasury yield, that is the one where I'm horizontal because nothing is happening and it's really boring. Yes, they're drifting a little higher at the moment, but quite frankly, it's still not a lot happening. And if there isn't a lot happening, there's not a lot that you can do, really, is there? So how about you move on and trade something else? Okay, so let's go have a look. Right? So we'll start with the euro. This is the weekly chart. I don't think I'm getting in anybody's way in the show later on. And I think it's always quite useful just to look at the Super Six. So guys, remember the theory here, right? This is the 6 markets in the world that you need to be following and really understand what all the technical points are, because they drive most of the other markets that are out there, right? You could add a couple more and go for the sexy 7 or for the exciting 8. It's up to you if you want to add a couple more. Sometimes you might want to add a local stock market. Sometimes you might want to add another exchange rate that you think is more important, but that's fine. Don't go beyond 8. There's no need. This should yes, you could. And so Crystal's asked, should we add Bitcoin? Well, yeah, look, it's only $1 trillion, Crystal. I'm just going to leave it out there. So, but by all means, if you're following it, then add it, right? That's the key message here, right? If it's something that you think is important, then you add it. These are the ones that I follow for looking around the world. You know, when you look at some of the foreign exchange transactions that go through, when you look at some of the oil trades that are going through, some of the gold trades that go through, the gold market is still 20 times the size of the, 15 times the size, I think it is, of the cryptocurrencies, right? So, although that does change almost every single day, but, you know, by and large, it's a much bigger market, right? And I think you just got to bear that in mind. And again, you know, look, Crystal, Bitcoin in itself, I'm not sure Bitcoin is $1 trillion, is it? Maybe it is. I think the whole crypto market might be $1 trillion. So, and that seems to be a bit fragmented. So, but again, add it if you think it's important. That's the key thing. I am not going to cover cryptocurrencies here. Shukri does an amazing job. From time to time, we will look at charts of them. We did highlight that Ethereum and Bitcoin was quite cheap about 2 months ago when Ethereum was trading down in the $1,800 to $2,000 mark. I said I thought it was going to move from there. Did I see 3,600? No, I didn't see 3,600. Of course not. I didn't think it was going to double. But as always with these things, they're opportunities, so I do follow them, but not all the time and not every day. So when we look at the euro, what are we seeing? Well, the euro on the weekly chart is just coiling out a slightly, you know, grinding lower, I think is how I do it, is how I would put this. It's had the last 4 or 5 weeks, it's sort of ground low. When you look at those big figures, we're moving like a big figure a week, and not even that. You know, some weeks we hardly move at all. And so this is what I'm saying with the volatility. It's not really big enough to take big positions and make a lot of money. But the general trend since June has been one where the dollar has been rallying and the euro has been falling. So take that into consideration, but we are sitting at major support around this level in the 115 mark. If it holds this, then maybe it bounces back to the 120. If it doesn't, then we may see back down to 111 and 110, right? So keep an eye on it. Trade it as you see it. Right now it's marginally bearish. I think you should have that attitude in mind, but marginally bearish. No throw up yet. So when you look at the daily chart, you can see how that marginally bearish pattern is unfolding, right? There aren't many up days, and where there have been, even we get 2 up days before the market sells off again. So Friday was considered to be an up day. I guess you could argue it's tracking a little bit of the way that the stock market is going. So stocks have a good day. It sort of feels a bit better. But again, you know, this may be another opportunity to sell it in terms of the overall direction, because we know the overall direction is down. And so what an opportunity this may be to try and put something on if the market bounces. So as I say, it's a grind lower. Take your time, wait to see the right opportunity, put the stop losses in, make sure your risk is tightly controlled. It's a little bit boring. Unlike the next market, and you know, for weeks and weeks and weeks I was saying how boring dollar yen was and how it was going nowhere, and then bam, we have that big move. The last 2 weeks has been really interesting, right? We had 6 days straight up, then we had 3 days down, and now we had another week where the market has moved significantly higher. Fits and starts, lots of rotation, but it's moved significantly higher, and we're sitting on a brand new high up at 112.23. Again, for those of you who follow my broadcast group, you know that we have a position in this. We've been long, I think, since 110.90 something or other, and we continue to hold that position just to see where it's going to go. And it was a really good performance on Friday, and that trade's working out for us, 130 pips up, something like that at the moment. It appears to be a breakout. So as the yen consolidated here, dollar yen consolidated, came down for a couple of days, we took advantage of that weakness to put a position on, and the market has gone in our favor. So again, trading this, the breakout is coming. Unusual for dollar yen to be going up when US stocks are trading not brilliantly. But these days, I'm sort of trying to figure out that unusual doesn't really matter anymore. And again, you sort of tend to trade it as you see it. We're seeing a general US dollar rally, vaguely general US dollar rally. We saw that in the euro, a grinding one. We're seeing it in dollar yen, a breakout one. So two different types of rallies. And then there's my new favorite market, right? My new favorite market is Aussie dollar, US dollars. So for those of you who don't know, there was a trade surplus. I think the trade surplus in the Aussie dollar this week was a all-time record, or recently, this last week, I believe it was last week, or the week before, all-time record for the US for the Aussie dollar in terms of the trade surplus, just pure numbers. Now, some of that is the currency impact called the J curve, which is a translation thing. Go look it up if you don't know what I'm talking about. But the general message here is that the Australian dollar is doing incredibly well because a lot of the commodities that it tends to export have had a run up in prices, and maybe we'll look at those a bit later on. So the reason why I've highlighted this yellow box is because I believe the Aussie dollar, if commodity prices remain reasonably strong, they don't have to go down. They just have to, or go up anymore. They just don't have to go down. If they just stay here, right, then those companies in Australia will continue to make a lot of money. And as a result of that, the Aussie dollar is getting ridiculously cheaper and cheaper and cheaper. And I think the only reason why this is not rallying at the moment is because the US dollar is so strong that it's having a downward influence on the exchange rate. So think about it this way. Something happens that causes the current US dollar strength to reverse, and the Aussie dollar is going to perform very well. So we've already got the beginnings of it here with this box, right? So the yellow box, you can see highlighted that we have a higher low. The market was moving up, it has corrected. 3 or 4 waves down, 5 waves down, you can see that it's gone and put a higher low in place on the weekly chart, and we just snuck in a close above the high of the low bar on the weekly. So let's see if we can see any more on, this is looking at the daily chart here, and you can see again what we had. We had a breakdown of the Aussie dollar out of a major support area. It broke down and then quickly rallied back again. For those of you that trade technically, this is what I call a false breakout, or a speculator's trap, or whatever you want to call it. And as a result of that, if I saw this trade, I would expect the market to trade back to the top of the trading range, which is up here, which it did. It took a few days to get there, but it reluctantly ground its way back up to the highs of the recent trading range, right? So, and this is where we sit. So my view, again, as I say, just to re-emphasize this, is I don't know when, I don't know how, but I think this is the big currency trade coming up, right? The Aussie dollar and the Kiwi dollar, because the Kiwis, in some weird and quite frankly unbelievable way, decided this week that they would raise interest rates. So in the middle of a pandemic outbreak. So anyway, the Kiwi has got interest rate and tapering on its side. The Aussie dollar has got amazing trade surplus on its side. Both really good reasons for the currencies to perform well. I think you need to keep an eye on that. I think that both of those are going to be the trade for some time in the next 4 or 5 months. We're going to see the Aussie trade up 7 or 8 big figures without even touching the sides. I'm really bullish, and it may be the start of a much bigger move for the Aussie, right the way up to parity again against the US. Who knows, right? Who knows? Not a prediction, I just don't know, right? But I'm very clearly positive on the outlook, providing the US dollar actually either stabilizes or start to weaken. I think you'll see a tremendous performance on the Aussie there. So please keep an eye on that, everybody. Another one of the Super 6 that I'm looking at right now is the oil market. This looks at the weekly chart. This is WTI. You don't have to be a genius to work out that I think last time we looked at these charts, I said, yeah, we were approaching the old highs and we'll see what happens when we get up there. Well, clearly we've broken out of the old highs and we've had 1, 2, 3, 4, 5, 6, 7 weeks up from here, right? Sort of the definition of a bull trend. However, there is a small problem, and the small problem that we're seeing occurred on Thursday. For those of you that follow WTI, on Thursday, would you have kept with your long position? Now, why did that long position get threatened? Well, we closed on, I think, Tuesday at $79 for WTI. Wednesday, we had a bit of a sell-off down to 77. You're going, okay, well, that's only $2. It's quite a lot, but it's only $2. The next day, we continued, right? And we then got down to 75. So let's get this straight, right? From 79 or just above 79 down to 75. That's close on a 6 or 7% correction in 24, 36 hours. That's enormous for such a liquid market like the oil market. And then we bounced back and we closed on a new high on Friday. Right, so go figure. So if you like, over those 2 days, we had a range of about $10. Right, and ended up slightly higher. Well, that's insane, right? And so this is where some of this volatility comes in. Back to the previous slide, you look at the previous weeks, right? The previous weeks you're seeing, and just looking at this week, you see, oh, it opened on the low and closed on the high. How boring, it's just a grind higher, seems to be breaking out. That's interesting. When you look at the dailies, you're going, oh my God, yeah, it began to go up and then it collapsed back again and then rallied up again. So testing everybody's sense of where their stop losses are, I think, is how I would describe that. And some of that volatility is absolutely enormous. You just need to bear that in mind, guys. This is the way the world's working these days. So what happens when it goes down $4 or $5 next time? Will you sell? Well, no, of course not, because you're saying, no, it's still a bull trend. And then, of course, it'll go down a bit more. Okay, so this is the reason that they get people out of their positions, because you get freaked out by either the initial sell-off or you don't turn the position on the next time down when it is actually the real sell-off, right? And so this is sometimes where trading can be really hard from an operational standpoint to actually make sure that you're managing the trade correctly. But I just, for me, when I see volatility like this, I think there's something more underlying this market, and it's a bit of a worry. We'll see what happens next week. Really critical week. We go back to visit this low down here. I'm going to have second thoughts about oil. Let's see what unfolds, guys. One of the things I wanted to talk about, though, when we look at the oil market, is to say, well, hang on, let's go back and let's just do some basic maths, right? So when we looked at this, you look back at September. Let's go back and look at a weekly chart, right? From about April, May time, the market was trading at about $60, and now it's trading at $80. So that's what, something in the order of 30% increase. Okay, that's quite a lot. Any normal year, a 30% increase would be spectacular. Not even close to some of its sister markets, right? Coal futures, the same place. Okay, we've gone back a year. Let's start here because it's the same place. They're trading at $90 and now they're at $240. So not 30%, try 130%. And for those of you that have been following some of the crisis that's going on in Europe, I've looked at the US natural gas prices, not the European ones, which are even more crazy, but the US natural gas prices, again, from about March, April time, we were looking at about $2.50 to $3, and we went up to $5. In fact, we went up to $6.50. Okay, so we more than doubled, 150% increase. So when we look at oil and we go, oh, well, it's only gone up 30%. That seems like quite a lot over the course of the last 6 months. Okay, I'm sitting there going, maybe that isn't enough. Okay, maybe oil has to go to $100. Easy. Right, now what would force it to $100? Well, who knows? But when you see, but I didn't know what was going to put coal up at 260, and I had no idea what was going to put natural gas up at 6. Okay, so when we're just looking at some of these things, this is why having this more holistic view is quite important, and we just scoot around the market. Sometimes it's not just the oil thing that we have to worry about. It's actually what else is going on as well too. Okay, guys, just another quick note. Some of the times I get quite grumpy about my transitory inflation argument because I always stress test it. There are some other commodities out there. There's not just oil and oil derivatives, right? There are some other commodities out there that haven't been doing very well. Look at iron ore. I'm not sure that anybody who trades iron ore will be having much fun. That's down 47% on the last 3 months. And I don't think many people either trade palladium. Right, but you can see where palladium, again, same time as iron ore, topped out in May. Palladium is now down enormously as well too, right? So there's been some really big moves in some other commodities. It's not all easy. Sometimes people talk about it being the commodities market, but sometimes it's actually a market of commodities. And one of my favorite ones is lumber, right? So, there was a really bad time to build a house. That was May of this year. If you looked at the lumber market in November and you looked at it again now, you think that nothing's changed. It's still sitting at 500. In the meantime, it went up 400%, and then came all the way back down again. Some of these interesting things, right? And by the way, just remember, with all of this stuff, right, one of the reasons why the US dollar is holding its position is because 70% of the world's commodities are invoiced in US dollars, right? 70% of the transactions are done in US dollars, right? So if the price of oil goes from 60 to 80, how many more dollars do you need? Well, you need 30% more dollars. If the price of coal goes from 100 to 250, how many more dollars do you need to settle that coal transaction? Well, you need 1.5 times more than you had when it was trading down lower. So even if you're commercial and you can pass these things on, the net impact out there, guys, is that you need a lot of dollars to buy things. That, I think, is one of the major reasons we're seeing for the US dollar rally. It is not a flight to quality. It's just really, really expensive in some commodity markets, and you need a lot of dollars to pay for it. And that's the reason why the US dollar is rallying. So as some of those commodity prices weirdly come off, we could actually see the US dollar falling. That doesn't make any sense, but it's just the way the world seems to be working it now. Look, guys, quick conclusion because we're running out of time. So the euro US dollar grinding lower in the euro, right? You guys get that story. I think there's another story happening in the UK, but I've still got to get my head around what the changes were at the central bank, right? Okay, so for those of you that missed it, there was a central bank redefinition that took place in the UK in the last 2 weeks, right? The government changed the central bank's mandate, right? And I'm still trying to work out what that means. They appear to have just given up on inflation, and they appear to give them a whole host of things to target, like their green credentials, like unemployment. I think they were looking at poverty levels and things like that. This is the government's reasserting their control over central bankers, right? And if that is the case, then again, long term, you've got to say, good or bad for inflation. There may be a point at which I have to change my mind about transitory inflation. There may be a point, if the central banks continue to lose their mandate to control inflation, that we're going to see a fundamental shift of power from central banks back to governments. And if that's going to be the case, then boy, oh boy, we are going to continue to see negative real yields for the next X number of years. More importantly than that, inflation may be a little bit more endemic in the system in the same way that the pandemic appears to have gone now. So, however, at the moment, I'm still sticking to my guns that I need to see loan growth. I need to see that money supply change. I need to see all of those things happen from a monetary economics point of view, because that's where my training is, before I get excited about secular inflation. I get the one-offs, but do we seriously think that coal is going to go from $250 a ton to $500 a ton next year? Maybe. Anything's possible, but right now I don't think so. So look, here's my quick conclusions, right? Euro grinding lower. Dollar yen, is it a breakout? It seems to be. Follow that, track it. For the time being, folks, it's going up, so trade it that way. Look to take opportunities on each correction. Oil, I still remain bullish on oil, mainly because of what's gone on in natural gas and what's gone on in coal. Its ancillary related markets have gone screaming higher. So why doesn't oil respond as well too? Incidentally, if you want to get a clue about what's going to happen to oil, keep an eye on those other markets. If they all now come off all of a sudden and reduce in price, both in the coal market and also in the natural gas market, then I think that could be a negative for the oil market at some point in time. And again, I keep coming back to this message. This is the reason why I'm still sort of I still can't give up on my transitory inflation view. The bond market's telling me inflation is a waste of time. It's going to come back, which seems to be a bit of odds with all the other information and spin we've got going on. So that's my confusion. And I've been not an anti-inflationist. I've been a transitory inflationist, I think, now for the last 6 months. I'm hanging by my fingernails to that view. I hope I manage to maintain it. We'll just see what happens to some of those commodity prices over the next 6 months. Guys, again, I hope that you got a little bit of extra information about the way the world's working at the moment out of this. And there's a question from Garrett. What causes 10-year yields to go up again, almost approaching February 21 highs, purely because of asset tapering? No, it's a complete misnomer to think, Garrett, that if the Fed doesn't buy treasuries, nobody else will. I'm pretty sure that if the Fed doesn't buy treasuries, there'll be a whole bunch of other people needing to buy them. So I don't think that that's as related. And in fact, if you go look at treasuries and yields of treasuries and QE, right, and look at the yield QE relationship, that doesn't hold at all, right? So yields don't correlate with QE purchases. It doesn't work. But there could be any number of reasons why US yields are going up again right now. There's a seasonality to it. Maybe some people are getting out of some of their bond positions. I'm not sure why. Maybe they're just reallocating money. Who knows? But the key thing is, look at the absolute yield levels, 150, 160, call me when it gets to 170, and then we can start to have a conversation. But all I'm going to say then is that it's just at the same level it got to in February, so who cares, right? Yeah, it's up a little bit on the year, but realistically, it was crazy low, and 170 is still a real yield of -4, right? So you've got to take that into consideration. So, yeah, right? Okay, guys, I think I'm pretty much done. I've got to skip because in a few minutes' time we're linking into the weekly Sunday update. So thank you for listening as always, and hopefully I'll see you next time. And any questions, obviously, please come through the normal channels if there's anything that you'd like me to talk about going forward. I tell you what I can share with everybody is that Ainsley and I think at the next Trader Cafe, it won't be a Trader Cafe. We're going to do a deep dive into gold and silver. So Ainsley's going to do the technical picture and I'll be doing some of the fundamentals to really unpick that gold market. We're going to go back 100 years and see if we can find something interesting to talk about with that for all you gold bugs out there, just because nobody's talking about it right now. And so there's nothing wrong with talking about a cheap market, right? Guys, thank you very much. And as always, if you have been, thank you for listening.
Cheers, Julian. Thank you, guys. Thank you for that. Thank you, everybody. We'll see you in the Sunday market update in about 7 or 8 minutes. See you there. Cheers, guys. Cheers, mate. See you.